Hello, viewers. Welcome to our part 5 of Business Fundamentals and Processes. So, in the last part, we discussed about the sales cycle or order to cash cycle. So, in this session, we will be discussing about the operating expenses. Basically, we will be trying to understand what are the operating expenses that the business will have to incur for them to run their operations and also take care of their business activities, right? So let's see what are the different kind of business operations. Okay, so first let us try and understand that what is an operating expenses. So I'll just read out an expense incurred in carrying out an organization's day-to-day activities but not directly associated with trading or production. So if you see an expenses incurred in carrying out organizations day-to-day activities, that means on a daily basis, apart from the trading or production activities. So basically, if you see, our expenses can broadly be divided into two major types of expenses. So one is indirect expenses, the other one is direct expenses. So broadly, the operating expenses consists of all those expenses that the businesses have to incur apart from the expenses associated with trading or production activity. So in the upcoming session, we will see the what are those expenses which are related or connected with trading or production activity. So now here, broadly, we are going to try and see what are those other expenses which are required by the organizations to manage their day-to-day operation. So the first one is the major aspect of it is going to be the payroll and the employee benefit. So payroll, basically the salaries, wages, depending on type of industry, like in case of a manufacturing, there are wages and salaries. The employee benefits are basically, apart from salary, there might be other benefits. For example, bonus companies might declare. Then the other expenses, like, we saw in our previous sessions that under this statutory compliance, we were talking about provident fund and ESI contributions. So in this case, what happens, there is a portion of amount which the employer needs to contribute towards these welfare schemes. Like in case of a provident fund, equal amount that is being deducted from the employee, the employer needs to contribute the similar amount towards the PF of each of the employees. So that amount of contribution which the employer contributes towards the employees welfare fund is an expenditure for the organization. Similarly, in case of ESI also, wherever it is applicable, for whichever group or type of employees it is applicable, there is a portion of there's a percentage of amount which the employer needs to contribute towards the insurance scheme. So that again forms part of the expenses. So all those expenses related to employee or payroll is what will get covered broadly under this payroll and employee benefit expenses. The second part is again, I mean, like, it's not in the order that I'm I mean, like, stating these expenses. It is just for you to get an idea of what are all the different kind of expenses that an organization uh, will have to incur, right, or may incur. Like some companies may not incur in marketing and selling expenses. So what are the marketing and selling expenses? Basically the advertisement and various other marketing activity expenses that the company needs to promote their product, right? So those are the expenses which might fall under this group of marketing or selling expenses. Then you have, in case as an organization, if you are taking services of professionals, like for example, chartered accountant, Now, again, the services of professional, we have seen in the company entity that in case of a private limited company, public limited company, right? So there, it is mandated. Remember, if you can recall, we had discussed about the compulsory tax audit. So in that case, there is no option by the businesses to take the services of the chartered accountant. It is mandated by income tax, so they need to have a chartered accountant appointed who is going to conduct the tax audit for them, right? So any fee that is paid to the professionals by way of consultancy charges, or by way of professional charges, or by way of an audit fee, in whatever name that you call, basically for the professional services rendered by these professionals for your business activity purpose, or which constitutes your business expenses, will fall under this professional services, various professional services expenses that you might have to incur. Then, of course, transportation, traveling. So this broadly covers your local conveyance. Then it could be travel by you as a owner of the organization, or your employees who need to travel on sales related activity or various other activities, developmental activities, right? So all those expenses will, I've just put them under a bucket kind of a thing. So where, when all those transport and traveling expenses can go, uh, these are some of the expenses which will get into the transportation or travel activities. And then office maintenance, right? So various kind of like, for example, in your organization, you might have to provide, you will have to maintain your office premises so that they are neat and clean, and they are taking care of hygiene every day. So these kind of expenses, generally, which are pertaining towards your office maintenance, uh, basically will come under this office maintenance part. Okay. Then comes your depreciation. So, what is depreciation? See, basically, if you see, income tax allows, even companies act, the private limited company and public limited company, they also allow the businesses to provide for depreciation. So, income tax also allows depreciation, provision for depreciation. So, first, let us try and understand what this depreciation is all about. Basically, an accounting method of allocating the cost of a tangible or physical asset, or sometimes, in case of income tax in India, it also considers the intangible asset over its useful life of life expectancy. Basically, if you see, depreciation represents how much of an asset's value has been used up. Now, if we consider the definition, or the income tax, what does it define depreciation as, right? So as per income tax, depreciation is a deduction allowed for the reduction in the real value of a tangible or intangible. This is where, income tax defines asset used by the taxpayer. So the concept of depreciation is used for purpose of writing off the cost of an asset over its useful life, right? So this is what basically is the depreciation definition that you can think of. But from an accounting point, for an organization, right? So the other aspect that we have to keep in mind about this depreciation concept, which the statute allows, is that, depreciation is basically, writing off of the useful life of the asset. That is what, we saw. So now what happens over a period of time, there is a life expectancy for each of an asset, right? So some asset might last for 5 years, 10 years, 15 years, right? So what happens, and why depreciation is allowed by the statute for businesses to claim as expenditure? Actually, if you see, depreciation is an expenditure. So why are we claiming that as an expenditure, right? So the moment you claim any amount as an expenditure, it is going to reduce your profit. Now, in case of depreciation, if you see all other expenditure, when you are uh, spending or when you are incurring this expenditure, there is a cash outflow to compensate for this benefit that we have acquired by way of, that is what basically we call as an expenditure. Now when we come to our accounting fundamentals, we will also discuss about what is an expenditure, how do you define an expenditure, what is an asset, how do you distinguish between an expenditure and an asset. All this we will see in the upcoming sessions. But depreciation here, basically we are now putting it under the block of operating expenses. Though you are not paying money to somebody immediately or at other point, or maybe at a later point, right? So you are not making any payment. So the idea is that whatever is the amount of depreciation that you claim, now again, the statute, like if the income tax is actually given you a table where you there is a percentage of depreciation that you can claim for each type of asset has been specified. So according to that, you can claim your depreciation on those block of assets. Similarly, the Companies Act also has a list of assets on which the depreciation can be claimed by the specified or prescribed rate of depreciation. There is a difference between the rate of depreciation that is allowed for assets for companies as per Companies Act and the rate of depreciation that is allowed for companies as per the Income Tax Act. Right, so we will come to that later. So this depreciation is basically an expenditure which you claim it as an expenditure. The whole idea of allowing depreciation, especially by the income tax, is that you every year the amount of depreciation that you claim as an expenditure is basically the amount that you are supposed to save it, so that over a period of time, since you're not going to make a payment to anybody, ideally this is the money that the income tax department gives you to accumulate, or you can save that money over a period of time, so that at the end of the life expectancy of any asset, you have enough fund available with you, so that you can quickly replace that asset and continue with the same efficiency of your business or efficiency of your production. Right, so that's basically about the depreciation part. And then comes your rent. Right, so if you are taking play office or factory on rent, then you have to pay rent on a periodic basis. Those are your expenditure. These are very simple for us to understand. And then repairs, right? So you might have various repair and maintenance activity that needs to be undertaken by you, timely repair and maintenance activity undertaken by you, so that there is no stoppage, or there is no any stoppage of your operation, or there is no any interruption in your production process. So you might have to take care of repair and maintenance of your machineries, your vehicle, and other office equipments. And sometimes you also get into the AMC. Okay, AMC stands for Annual Maintenance Contract, where basically you enter into a contract by paying a prescribed amount for the entire financial year. Or for 12 months, generally it is a 12 month. Now the AMC could spill over multiple financial year, two financial year, not multiple, two financial year also. Right, it's basically, it's generally it is a 1 year contract that has been taken. So we will come to that little later, that how you treat this expenses, which is falling partly or partially in the current year, and also partially in the subsequent year. Right, we will cover that. So the repair and maintenance are basically those kind of expenses which the company needs to take care as an operating expenses. Then taxes. So taxes, you must be wondering why taxes is coming under expenses, right? So generally, if you see taxes that are being levied by the company, especially if you see the GST aspect, right? So as a business, when I'm selling, I'm supposed to charge GST, right? So generally, if you see, these kind of taxes are never paid out of pocket of the businesses. So they collect from the sale profits and they reduce the tax that I've already paid on their purchases, and the excess amount of tax that is left over, which means basically the tax that is collected on the value addition on sale, is what they have to remit to the government department. Right. So again, we will see that when we get into the GST part. So these are the taxes where if the company have to pay from their kitty or from their pocket, then those taxes are the expenses for an organization. Now, don't worry, we will discuss about the detail of what are the taxes that are expenses in nature, and what are the taxes that you collect and then pay them without considering those amount that you pay to the department as an expenditure. Okay. And then the communication. Right. So lot of other things you can put into this. That's why I've made them as a block of expenditure so that we get a idea. So communication, of course, yes, your telephone expenses, then your internet charges, and various other charges that anything which is related to the communication is what basically you will put them as your expenditure pertaining to the communication group we can talk of. So broadly, if you see, these are an indicative expenses. There could be more expenses which are there, and it is not necessary, like I had mentioned earlier, that it is not necessary for the businesses to incur all these types of business, whatever all these types of expenses. So whatever is the expenses that the business, depending on their nature of business or on their activity and the operations of the business, they will incur this business. The whole idea of understanding this operating expenses by us is that what are the different kind of expenses which are in the nature of an expenditure that we need to account for in the organization for maintaining a proper books of account, and also generating a true and fair financial statement. Right. So the next quickly we will see about the business operations. What are the types of accounting entries that as an accountant or as a owner that I have to start capturing, so that I know my state of affair of my business. Right. So if you see accounting entry, what is an accounting entry? Very, very important. We are going to get into the detail of this accounting transaction when we go to our next topic, which is going to be the accounting fundamentals. Right. So before we go there, we'll just try and understand what kind of. So in the previous slide, we saw what are the different types of operating expenses the businesses need to incur. But then how are you now going to start capturing the accounting entries, and what kind of transaction or what kind of event is what you are going to capture them as an accounting entry. So first, let's try and understand what do you mean by accounting transaction or accounting entries. An accounting transaction is a business event having a monetary impact. So very important for us to remember these two words: monetary impact. So any transaction or any event in the business, if there is an impact of money or if there is a monetary impact for that particular transaction, those are the transactions which are need to be captured as my accounting entry. So basically, these are the transactions which have a monetary impact on a day-to-day affairs of the business and financial statements of a business. It is going to impact the financial statement of the businesses. Right. So now, what are the types of expenses, or what are the type of not just expenditure, what are the type of financial transaction that we need to start capturing them in our books of account? So the first, if you see, very simple: any sales, any purchase, whether you make it, whether you make the purchase or sale by cash or on credit. So every sale needs to be accounted for. If you are making a credit sale, then you are going to basically account for the sales, and also you are going to account for the person who has purchased the goods from you on credit, because the person has to pay money at a later point in time based on the credit period that we have provided to him. So similarly for the purchase also, right? So then all those expenditure which we saw in the previous slide, so all those expenses which we incur on a day to day basis, and if you see they have a financial impact, so financial impact need not have to be instantaneous, right? It can happen immediately, which is basically I incur an expenditure, I make a payment immediately. Or I buy something, like for example I buy stationery for my office use, I immediately pay cash and then buy stationery, right? So stationery is my expenditure because I made payment of cash immediately. There is a monetary impact, right? Or I might be buying, my expenditure could be in the nature where I would be getting a credit facility also. So just you have to make sure that any transaction which is going to have an impact of monetary uh, aspect, immediately or at a later point in time you're going to record, and all those expenses we saw by way of operating expenses and also expenses related to purchase and sale will be recorded in your books of account. And purchase of, obviously the purchase of a asset, any asset that you are going to buy, we will be accounting for. So in our fundamentals of accounting we will see how do you differentiate between an expenditure and an asset. Because if you see, uh, expenditure is very simple, that all of us know that, it is basically you are spending money for uh, getting some services or benefit. But asset also, actually, it is kind of an expenses, right? So you have to pay money to acquire it, right? So we will see in our fundamentals of accounting how do you distinguish between this expense and asset, and what is that thin line that segregates a transaction as an expenditure or asset. We will look into it. And then if any receipt, like you have made a sale on credit, so the customer is making payment, so when you're receiving money you have to account for it. Similarly, when you're making payment to your vendor or your sundry creditors, you have to account for it. Okay. And then recording of depreciation. So based on the statute, okay, so you have to record, if you are a private limited company or a public limited company, then you have to record depreciation as per Companies Act in your books of account. And when you're filing your income tax return, you have to compute your income depreciation as per income tax return. And then you need to make your computation of income, and then you will arrive at your taxable income. So you have to record depreciation. So there are different ways of recording depreciation. We will discuss about that when we get into the fundamentals of accounting, right? And then borrowings and lendings of fund. So you take loan from bank, you have to definitely account for it. You give advance to your employees, or you give advance to your sister concern in case of a group company, so you have to account for it. So for all this, if you see, uh, you will realize that there is a monetary impact, right? So that is why we have to capture all this as an accounting or financial transaction for in our books of account. Okay. Then investments, deposits, and advances. So basically, I've discussed about this. If you're investing money from your company, see everything here, you have to see from a company's point of view, right? Nothing to do with the as a proprietor company, nothing to do with the investment of the proprietor as an individual, or nothing to do with the investment or borrowings of an individual as a proprietor or as a partner. So this whole thing, every accounting entry that you're going to capture should be in relation to the business operations. Okay. And then provisions, what are the provisions now? This is not the provision that we buy on a monthly basis, right? So these are the provisional entries that we have to ensure that we are capturing them before we finalize our books of account, or before we sign off our financial statement. So this provision is basically, if you see, it can happen in case of expenditure and also in case of income. So generally, if you see, the statute, if you take income tax, it says very clearly, whatever is the expenses that you have incurred for a given financial year, all those expenses need to be accounted for in that particular financial year, irrespective of whether the payment towards that expenditure has been paid or no. So similarly, if there are any income which is accruing for that particular financial year, and irrespective of whether you have received the money towards the income or no, doesn't matter, you have to account for it. So basically, you have to account for all expenses and income for the given financial year. Now, let me give a use case here. Now, here, if you see, many in MSME segment, if you see, many of the companies, they have this practice of paying salary to the employees by the 5th or 7th or 10th of the subsequent month, right? So now, the month of April you pay in May, doesn't matter, it falls within the financial year, whether you account it on April 30th or whether you account it on May 5th or 7th or 10th, it doesn't matter, because the expenditure is pertaining to that particular financial year. So similarly, if you see, April paid in May, February paid in March. Now March paid in April, the salary is basically, salary is pertaining to the month of March, which is the current financial year. But when you're discharging the salary, or when you're making the payment of salary, you're doing it on 5th, 7th or 10th of April, which means you're making the payment in the subsequent financial year, right? Now, if you see, this 1 year, okay, 1 day makes the difference between 1 year. So this is very interesting thing. I mean, we all know this. 31st of March date and 1st of April is two financial year. 1 day makes a difference between uh, switching off one financial year to another financial year. So now, what is this provision that you have to make? Now, my salary is my expenditure. I have to pay salary because I have taken the services of my employee for the month of March, for which I need to compensate, right? And that's what we call it as salary. So now, irrespective of whether you are making payment or no, what the income tax says, you account for that expenditure. Okay, so I'm accounting for that expenditure as salary and debiting my P&L account, right? So I'm not making payment. Normally, if I make payment, my cash or bank account gets credited. So in this case, I am not making payment. So what am I doing? I'm debiting my P&L account towards the salary, right? Since I'm not making the payment, I create a liability. That is what we basically call it as a provision. And for you to, just to understand this much more easier way, or in a better way, just think that anytime you are making a purchase on credit, so what is the entry that we are passing? We are going to debit the purchase account, and we are going to credit the supplier account, name of the supplier, sundry creditors, you create the account and you credit. Why are you crediting him? Because you are creating a liability, uh, because you are not making the payment immediately on purchase of goods or services, right? At a later point in time, you are going to make the payment. So that is the reason why you are creating a liability. Similarly, I'm debiting my expenditure as salary on 31st of March, and I'm also creating a liability as salary payable, or I can call it as outstanding salary. It all depends on how you want to uh, give a name. The nomenclature is all, it depends on organization to organization. So you create a liability called salary payable. So the question might come, why can't I put it under sundry creditor? It doesn't make sense, right? So that is the reason why we have this account called outstanding liability as a group, We will discuss about that all when we come to the fundamentals of accounting. So you have outstanding liability, where in some cases you might have provisions, so you put them there. Okay, so similar example from an expenses, your telephone bill, right? Maybe your water bill. Example that we have taken is the salary payable. Similarly, if you see in case of your electricity bill, uh, mobile bill, telephone bill, water bill, and all those things are not going to come exactly by the end of the month. So you will get a bill where you might have to pay in the subsequent month. So all these things you have to take care and make sure that you know all those expenses which are pertaining to for the current financial year is what you are accounting for. And if you are not making payment, because these are, you know, I mean, like, you know, in the next 4 days, 5 days, you're going to make a payment, or in the next 10 days, you're going to make a payment, right? It's a short term liability for all of you, right? So that is how you put them under your current liability as your outstanding liabilities. So similarly, these kind of expenses which are incurred and the payment is going to be made on a subsequent day, and if the subsequent day falls in the next financial year, you make a provisional entry. And you can call this as telephone bills payable or outstanding telephone expenses, whatever is the name that you want to give. So that's as far as the expenditure is concerned. And the same logic is going to be applicable for your income also. Now, on the income side, what are those income that the organization as have earned, but then it is the amount has not been recovered, right? Let's take the same example. In let's say in your business you have a building of your own, so the company has a building of its own, and the building is in the name of the company, and there is one uh, portion of a building where you have let out on rent to some other business, right? So now every month rent that you are going to get is the income of the business. It is not individual, because the building is in the name of the company, right? So every month you're getting, let's assume that again in this case also, the rent of the previous month is paid by 5th or 10th of the subsequent month. So the same logic applies, like what we discussed about the salary part. The same thing is going to be applicable for rent receivable also, right? So in this case what happens, uh, March month rent, let's say 25,000 rupees is the rent that every month is the income for you, right? So now for the month of March, right, so there is an income of 25,000 rupees, because your tenant is utilized the office for the month of March, which he needs to compensate. So but he is going to pay on 10th of April. So what you need to do, like the way you accounted for all those expenses pertaining to the current financial year, similarly you will account for all the income that is getting accrued, which means accrued is basically you have earned but then not received the monetary aspect of it for those income. So you will now create account saying rent receivable, and that becomes your asset. It is not your liability, because you're going to get this money at a later point in time, and you're going to credit your P&L account with the rent as your indirect income. Again, when we come to the accounting fundamentals, we will try and understand what is the difference between a direct income and an indirect income. How do you identify an income or expenditure as direct or indirect, right? So I hope the session would have given you clarity on what are the operating expenses the companies need to incur on a regular basis. So we saw different types of expenses which the company needs to incur for running their business. And also we saw in this slide, we saw what are the accounting transactions, what type of transaction that we need to start capturing in our books of accounts, right? So I hope again this would have given you more clarity. In the next session, we will see what are the other aspects. Like for example, what is inventory management? We will talk about. So all this while we have been talking about the accounting aspect of it, then we will also see what is the what are the processes that are involved in the inventory management, especially in case of a trader or a manufacturer. Inventory management is going to be again a major activity that the businesses need to undertake, and they should have more or better control over their inventory management, right? So the next session, the sixth part, is going to basically, we will complete the fundamentals of business and processes, and after that we will get into the fundamentals of accounting. So thank you once again, all of you, for being till the end. And if you like, please subscribe and press the like button, and see you all in the next session. Thank you very much.